Why smart people still lose money in Forex. Many people believe that being intelligent guarantees success in trading. They believe that if someone is smart, analytical, and well-educated, they should naturally perform well in the Forex market. But the reality is very different. Some of the smartest people in the world still lose money in trading. Engineers lose money. Economists lose money. Even financial professionals sometimes struggle in the markets. So the question is simple. Why do smart people still lose money in Forex? The answer is surprising. Because trading success is not primarily about intelligence. It is about psychology, discipline, and emotional control. And many intelligent people struggle with these things more than they expect. Intelligence can create overconfidence. Smart people are used to solving problems. In school or in their careers, intelligence often leads to success. When they study something, they usually figure it out. So when they enter the Forex market, they bring the same mindset. They believe they can analyze the charts, understand the system, and predict what the market will do. But markets do not work like exams or mathematical problems. The market is driven by millions of participants making decisions at the same time. Banks, institutions, algorithms, retail traders, and because of this, the market is full of uncertainty. No matter how smart someone is, they cannot control or perfectly predict what millions of people will do next. But intelligent traders sometimes believe they can. This creates overconfidence. And overconfidence often leads to bigger risks, bigger mistakes, and bigger losses. The need to be right. Another challenge for intelligent people is the desire to be right. In many professions, being correct is extremely important. Doctors must be right. Engineers must be right. Scientists must be right. But trading is different. In trading, being right every time is impossible. Even professional traders lose many trades. Sometimes they lose 40% or even 50% of their trades. But they still make money because their winning trades are larger than their losing trades. Smart traders often struggle with this concept. They become emotionally attached to their analysis. They want to prove their prediction is correct. So when the market moves against them, they hesitate to accept the loss. They hold losing trades longer than they should. They move stop losses. They hope the market will return. And that small loss becomes a large one. Overthinking the market. Another problem intelligent traders face is overthinking. Smart people love complex solutions. They analyze deeply. They study many possibilities. They search for hidden patterns. But in trading, simplicity often works better than complexity. Many successful traders use simple systems, clear rules, clear risk management. But intelligent traders sometimes complicate things. They add too many indicators. They constantly change strategies. They analyze every small movement in the market. This creates confusion and hesitation. Instead of making clear decisions, they become trapped in analysis. And when traders hesitate, opportunities disappear. Emotional pressure. Trading involves real money. And whenever money is involved, emotions become powerful. Fear, greed, frustration, hope. Even intelligent people cannot escape these emotions. When a trader sees their money increasing, excitement appears. When they see their money decreasing, fear appears. These emotions can easily influence decisions. Traders may close winning trades too early because they fear losing the profit. Or they may hold losing trades too long because they hope the market will recover. Intelligence does not protect someone from emotional reactions. Emotional control must be learned and practiced. The illusion of control. Another mistake smart traders make is believing they can control the market. Because they are good at solving problems in other areas of life, they assume the market is another problem to solve. But markets are not problems to solve. They are environments to manage. You cannot control what the market does. You can only control your own behavior. Professional traders focus on managing risk, not controlling outcomes. They accept that uncertainty is part of trading. And they build systems that work within that uncertainty. Lack of discipline. Knowledge is not the same as discipline. A trader may know everything about technical analysis. They may understand risk management. They may study charts every day. But if they cannot follow their own rules, none of that knowledge matters. Discipline is what turns knowledge into results. Professional traders follow their plans consistently. They do not change rules because of emotions. They do not chase the market. They simply execute their strategy again and again. Over time, consistency allows their statistical edge to produce results. The power of trading psychology. Many traders spend years studying strategies, but they ignore the most important part of trading, their own psychology. Trading psychologist Mark Douglas explained that successful trading requires a different mindset. Instead of trying to predict every market movement, traders must learn to think in probabilities. This idea is explained deeply in his famous book Trading in the Zone. Thinking in probabilities means understanding that any single trade can lose. But over many trades, a good system can produce consistent profits. When traders accept this concept, they stop becoming emotionally attached to individual trades. They focus on execution instead of prediction. The real skill of trading. The real skill in trading is not intelligence. It is emotional discipline. It is patience. It is risk control. And most importantly, it is consistency. Successful traders follow their systems even when emotions try to interfere. They treat trading like a long-term probability game, not a short-term prediction game. Smart people lose money in Forex not because they lack intelligence, but because trading requires skills that intelligence alone cannot provide. It requires emotional control. It requires discipline. It requires the ability to accept uncertainty. And once traders understand this, their perspective changes completely. They stop trying to outsmart the market. Instead, they focus on controlling themselves. Because in the end, the greatest challenge in trading is not the market. It is the trader's own mind. If you enjoyed this video, subscribe to Mental Edge Trading for more content about trading psychology, discipline, and the mindset needed to succeed in the markets. Because in trading, your greatest advantage is not just your strategy, it is your mental edge.